It's Alissa Coram here, and today I'm joined by my colleague Ken Shreve. And on the show today, we're going to be talking about how to supercharge your portfolio with ETFs. We're going to talk about how we use them to spot sector rotation, what you should know about leveraged ETFs, how you can gain market exposure with ETFs, looking at thematic ETFs, and so much more. There's a lot of ground to cover, Ken, and we already have so many great questions from the audience before this episode has even started, and I know we'll get a lot more great comments throughout the next 30 minutes. But like I said, there's a lot of ground to cover here when it comes to utilizing ETFs.
Well, no doubt about it. They're still wildly popular. They first were introduced, say, in the early to mid 1990s, and I haven't seen data from 2022 yet, but I do know that ETF inflows in 2021 topped $1 trillion with a T, $1 trillion for the first time. So they're still wildly popular, and for good reason. And it seems like every day there's a new ETF fund family that's coming out with new offerings. So a lot to choose from. A lot of different ways to use them. So let's get to it.
That's right. Yeah, there's an ETF for everything, it seems like these days, and so many clever tickers as well, which I always get a little giggle out of when they can come up with a clever ticker to go along with whatever that ETF is tracking. But before we dive into things like sector rotation and market exposure, let's first just go over a couple of the main benefits of ETFs, Ken. I mean, primarily, first of all, that diversification that you get that can be so helpful.
Yeah, I mean, I think ETFs first really became popular because they're basically mutual funds that trade like stocks, and there's a lot of great funds out there, but some of the better performers tend to have pretty high front end loads or back end loads or just high expense fees in general. And ETFs basically, like I said, they trade like a mutual fund during the day. You can buy and sell just like an individual stock, and they're very tax efficient, and they're very cheap to trade. So it's just become a great alternative to mutual funds, and that's why they've become so popular.
Yeah, and I think another thing to keep in mind to sort of set the stage here as we dig in deeper is to know what you own with ETFs, because you can have ETFs that have equal weights. You could have ETFs that are heavily weighted in a couple of stocks. So it's really important to do your research when you're looking into a theme or a sector or what have you, to really make sure you know what you own inside those ETFs.
Well, there's no question about it. Some ETFs have some stocks that are a 20% weighting. A lot of ETFs tend to the weightings are fairly equal from top to bottom, but some have a couple of stocks that might make up 30 or 40% of the ETF. So knowing what you own is very important, and you also want to pay attention to trading volume, because there's a lot of ETFs out there that trade less than 100,000 shares a day. So liquidity is something that you want to look at. I mean, if you're a retail investor and you're buying couple hundred shares, maybe an average daily trading volume of 75,000 isn't a big deal. But if you're a mutual fund, I mean, mutual funds own ETFs too, but they're typically going to look at a lot more liquid ETFs and avoid those that trade a very light trading volume.
Absolutely. And one more note on sort of the weightings in ETFs. Sometimes it can be favorable. So it's not to say, only go with equal weight ETFs. I mean, sometimes you can really get even more juice, or really supercharge your portfolio without having that single stock risk if you do have some more of that concentration in those top weightings. So it really depends on what you're seeing underneath the surface, what's going on with overall market conditions. And I think that's actually a great segue to our next topic, Ken, which is not just buying ETFs for your portfolio, but first of all, just using ETFs to spot where there's strength in the market. I mean, like this year, we've seen technology really come into the fore, whereas last year it was really all about energy. So we're seeing some of those shifts underneath the surface on a sector level. And one way to spot that is with ETFs.
Yeah, no doubt about it. I think, on our leaderboard model portfolio that we run at Investors Business Daily, we have 6 ETFs, and that's the most that we've owned in quite some time. But so we've got exposure to the semiconductor sector, to the retail sector. The stock market has come under a lot of pressure as interest rates have been rising again, and money has been flowing out of bonds, and that's kind of spooked the stock market. But kind of paying attention to sector rotation, and I know oil had a big sell-off on Friday, and so that fueled some selling in the XLE. So you just want to pay attention to sector trends, and that's a great way to do it is with exchange traded funds. Here's the XLE, which I think the top weightings here are Exxon Mobil and
Chevron.
Chevron, exactly. You can see a big gap down below the 50-day moving average. This is kind of bearish technical action for XLE. But again, lots of different ways to play different sectors. If you're long energy, if you think energy price and oil prices are going up, you look at the price action of XLE today, tells me that maybe the chances of higher oil prices from here might not be so good.
Right. So this is one way that we can uncover sector rotation. So if you just compare and contrast, here's a look at XLE. And we can even look at a weekly chart here. I mean, there's no doubt that the first half of 2022 was really dominated by energy. Let's take a look at XLK. This is the Sector Spider ETF tracking the technology sector. And you can see it really coming to life here as 2023 kicks off, breaking a downtrend. So trending higher as we see XLE go flat, sideways, and even down. So that's just a signal of where money is rotating in the market. I know something else that we also like doing, Ken, is you can see by what sector ETFs are the standouts on a particular day to sort of get a gauge of the risk appetite as well in the market. Is this a risk on day? Is this a day that people are going more towards the staples and the more defensive areas of the market? The consumer staples or utilities that can kind of also just give you a sense of the vibe, as it were, of risk appetite in the market.
Yeah, definitely. I'd like to just go back to the weekly chart for XLE for a second and just talking about the weakening technical picture here. You mentioned obviously it was a big winner in 2021, and it recently tried to come out of this consolidation just recently, and just really had a hard time making headway. Now it's been bumping up against prior highs, and now it's really flirting with a break of a longer-term support level here. It's still holding above it, but the relative strength line, again, with these MarketSmith charts when we're assessing the health of an ETF, we'd like to see a nice relative strength line trending higher. You can see with XLE, the relative strength line has been trending lower as the ETF has been moving sideways. So what's critical to watch right now for XLE is if it's going to hold this longer term support level, this 40-week moving average on the weekly chart, but looking much weaker now than it did in 2021.
Right. Well, now that we know how to spot sector rotation, then what do we do with that information? There's a couple of actionable ways that you can go about taking action based on where you're seeing the money flowing. One is, all right, so if we know that money is flowing into technology, well, let's take a look at leading stocks in the tech sector and try to find buying opportunities there. But if all of the stocks in the group become quickly extended, Ken, going with the ETF over an individual name might be the way to go. I mean, SMH is a good example here. We've seen a lot of chip stocks really kick it into high gear in 2023. But many of the leading names in this sector became quickly extended from their moving averages. So past the time that we would consider proper buying opportunities. But then that's where you could look to an ETF to get exposure to a theme.
Yeah, I mean, SMH is just one ETF that we currently have on leaderboard, and we put SMH on January 23rd, right around 236, 237. So it's given some of the gains back, and now we're kind of watching it to see if it can hold this short-term support level. Again, the stock market has come under pressure. A big reason why the Nasdaq has been performing so well since we saw that initial sign of strength on January 6th is the leadership in semiconductor stocks. So, and again, higher interest rates are starting to become a problem again here. But we're still holding SMH, but we actively manage leaderboards. So if we start to see sell signals, whether it's an individual stock or an ETF, we won't be afraid to take some profits or cut losses. So at this point, SMH is really just about a battle here at the 21-day moving average. It's trying to hold the line right now, but we'll see how it shakes out.
Yeah, and you bring up something that relates to a question that we have from the audience. Rick is asking, what are the best sell signals to use for ETFs, whether you are a swing trader, so maybe a couple days to a couple weeks time frame, versus a position trader, couple weeks to a couple months, ideally, if market conditions are favorable, and how that differs from the buy and sell signals that you would use for individual stocks. It seems like when it comes to sector and thematic ETFs, the rules would be pretty similar for buying and selling. But when we talk about getting market exposure, maybe that's where we treat things a little bit differently. But what do you think about buy and sell rules for ETFs?
You know, I really try to keep it the same as I do with individual stocks. So, like I said, with SMH, we're just kind of watching to see how this performs at short-term support levels. If it breaks below this 21-day line, it's not the end of the world, but our gain is going to be getting smaller. So your two top holdings here are Taiwan Semiconductor and Nvidia. But in terms of sell signals, I use the same sell signals as I do with individual stocks. I watch the short-term support levels like the 10-day and the 21-day line, and then longer-term support levels like the 50-day and the 200-day moving average, and watching the volume too in an ETF. Sometimes volume will really expand. You can see as we're looking at SMH right now, volume is about 45% above average. So we're seeing some volume in the market today, at least tracking a little bit above average in SMH. But I would say the sell signals are the same with ETFs as with individual stocks. You just want to watch how they're behaving around key support levels, and if you see, you just watch volume on up days, watch volume on down days. One reason the market rally has been working so well since early January is that we've seen, particularly on the Nasdaq, and maybe if you want to pull up QQQ here real quick, you can see all the volume that has been behind the Nasdaq during its recent ascent. We've seen some above average volume increases and some lower volume declines. Now we're at a point where QQQ is starting to get a higher volume decline yesterday, and the QQQ also testing this 21-day line here. So watching volume, watching how an ETF reacts around key support levels is what you want to be doing.
Exactly. And an anonymous question came in asking, how do we determine the right buy and sell prices for ETFs? And if we are using similar rules, just adding to what you were saying, Ken, looking for uptrends, looking for price consolidations, looking for pullbacks to moving averages, and those patterns in volume, and looking at support and resistance. So those are some of the core things that we look at when we're looking at proper entries. There was also another question of, how do I find the best ETFs? Well, once you're trading a lot, you start to come up with a list of what the various index tracking ETFs are, what the top sector ETFs are to look at. And we're covering those all the time, whether it's on IBD Live, at investors.com, to really show our audiences where the money is flowing. But if you want to come up with a list or find a list, we have lists of ETFs available where you could just go through like you would screen for individual stocks. You could take a look at those ETFs and get those clues about where we're seeing money flowing in the market.
Yeah, no, yeah, absolutely. And I just think that, especially looking at these market ETFs, the longer you trade them, and again, the more stories that you're reading at investors.com. I know every week on IBD Weekly, we've got a special section devoted to exchange traded funds. So every week there, and then daily coverage at investors.com as well. So as you start trading them, you'll start to gravitate towards the names that have interest to you. But certainly, the index ETFs, the sector ETFs, there's a lot to choose from out there.
Yes, there is. So let's talk a little bit more about index tracking ETFs. And there are so many of them. A popular one is QQQ, which is tracking the NASDAQ 100. SPY, obviously tracking the S&P 500. You can get double or triple leveraged versions of these. Double for the Qs would be QLD, triple would be TQQQ. For SPY, you've got UPRO as your triple leveraged version there, and you've got the inverse versions of these as well. So you can use ETFs to get market exposure at key turning points, also to hedge your portfolio. But first, let's talk about how we might gain exposure to the market with index tracking ETFs at a key market turning point, because maybe there aren't a lot of stocks that are in quality setups, but if the market is trying to make a move, we want to be there when it does.
Yeah, we did well with UPRO, which is the triple S&P 500, and we haven't used this much, and we don't own it now, but yeah, we put UPRO on down in late 2020 and really capitalized on a nice uptrend for the market. More recently, interestingly enough, I mentioned this buy signal that we got in the market on January 6th when we saw follow through days for the NASDAQ and the S&P 500. And on January 6th, we put on the RSP, which is probably a index ETF that people may not be familiar with, but this is just the equal weighted version of the S&P 500. So you have SPY, which is market cap, and RSP, which is equal weighted. So there, Ali highlighted where we put it on, and it's come under a little bit of pressure here, still holding a nice gain in this ETF, and trading a little bit below its 21-day moving average as we're looking at this, but trading kind of in the middle of its range. So we'll see if it can hold around this 150 level. The break of that 21-day line could bring a visit to the 50-day moving average into play, and we'll see what happens. But it's kind of trading in orderly fashion right now, and nicely above our initial entry on January 6th.
Yeah. And then also for inverse ETFs, perhaps that's a way to hedge your portfolio. SQQQ may be a popular vehicle for that. That is the inverse of the NASDAQ 100. I know, Ken, I believe you've also used the inverse of the S&P at potential turning points in the market, maybe like when we're getting overheated. I feel like that's usually the best time to go with an inverse ETF, is when you're seeing the market getting really extended from the moving averages. Maybe you have some big cushions in a lot of stocks. And if you are anticipating a market pullback, hedging could be something that traders are interested in doing.
Oh yeah, absolutely. And with so with the S&P 500, you've got basically three, short ETFs. You've got the SH, which is basically, I'm going to go short the S&P 500. And what's interesting here is you can see with the market acting so well, this has really, come off high. So and now what you see is an ETF that is in a pronounced downtrend that is going to have a lot of overhead supply to work through here. So it could get back up to that 50-day moving average. That could turn into a resistance level where it gets turned away. And even if it rallies above that, it still has that 200-day line. So a lot of these short ETFs, even though a lot of people, again, are worried about interest rates and we may be, maybe on the verge of another leg down for the market, the technical picture of these short ETFs don't really tell me that they're really ready to get moving yet. They're still on downtrends and they're still below these key moving averages. So no reason to get entirely bearish on this market just yet.
Mm-hmm. And a lot of times when we talk about either inverse or leveraged ETFs, a lot of times what we do at Investors Business Daily is we look at the underlying to make our decisions on those leveraged or inverse ETFs. So for SH, I mean, it is a little bit more clear to be able to look at the chart action here. But I mean, SQQQ, I know a lot of times, for example, depending on like if we've been in a strong uptrend, it can get pretty tricky to look at these charts. So it's usually better to make those decisions on the underlying when you're looking at leverage, even on a sector level. Like if you're going with LabU, that is the 3 times of the S&P biotechnology index. I know we were looking at the single for that. There's IBD, and then I think that's no, this is the Nasdaq Biotechnology Index. But anyway, there's XBI is the single version there of the S&P biotech. So yeah, if you're looking at these triple leveraged, make your technical analysis decisions on the underlying.
Yeah, and you don't want to be, adopt a bearish outlook on the market unless the indexes are really giving you those signals. And
right.
On Thursday we saw a pretty bearish day for the stock market. That was when James Bullard, who's probably the most hawkish Fed president, came out and said, he could possibly see a 50-point increase. But you want to watch the action in the market and pay attention to higher volume declines. I mean, we really try to keep our when we're observing market health, we try to keep it simple just by looking at higher volume declines. Since we've been in this confirmed uptrend since January 6th, we've only had 3 higher volume declines on the S&P 500 and 2 for the Nasdaq. So that's not going to get us totally worried about this market. However, if we do start to see distribution days pick up, higher volume declines, big percentage declines in higher volume, then we get a little more cautious on the market and might consider one of these inverse ETFs. But right now, still a little too early, especially as we see the Qs here are still holding above the 21-day line and just making what looks like a normal test here.
Mm-hmm. And in addition to your leverage and inverse versions of the S&P and the Nasdaq, of course, you have Dow ETFs, you have Russell 2000 ETFs. Like we said at the top, there's literally an ETF for anything. And if there's one you're interested in, just a quick Google and you will see what those are. If you're looking for a travel ETF or an airline ETF, the airline stocks made a move towards the beginning of the year. If you're looking for artificial intelligence exposure, if you're looking for exposure to, I don't know, cybersecurity stocks. I mean, there really is an ETF for everything.
There is, and I actually would like to take a look at the Dow Jones ETF DIA, because if tech stocks have come under selling pressure, you can see the DIA is itself making a pretty key test here. You can see it came down to the 50-day moving average on Friday morning, and has already climbed off lows. So while you've got some pronounced selling in the technology space, you've got blue chips all of a sudden that are maybe getting more interesting. So DIA, for people looking to go long the Dow, you want to see it find support at the 50-day moving average. So it's making a good fight there right now. And then another industrial ETF. This is XLI. It's also I believe a spider. The industrial select sector spider. So DIA is a price-weighted ETF. So UNH and Goldman Sachs are going to be the heavy-weighted stocks here. But XLI, you can see, has a really different look than DIA here. This is in a pretty decent setup. It's still showing relative strength, still holding comfortably above its short-term moving average. So you have two blue chip ETFs here, DIA and XLI, that just look a little different because their holdings are different. So at this point, looking for a good blue chip ETF, we give XLI maybe a little bit of a nod over DIA right here, just because it's showing better relative strength at this point.
Yeah, great point there, Ken. And before we move on to touch on other points that we want to make about ETFs, there's a question from Mike on elaborating the risks of using inverse and leveraged ETFs beyond short-term periods. You have that issue of contango with the leveraged ETFs, even if it goes sideways over time, just due to the nature of how these are structured to be leveraged funds. So can you comment on that?
Well, I mean, leveraged ETFs aren't for everyone, and in fact, we rarely use them on the leaderboard model portfolio. I mentioned back in late 2020 we did use UPRO, but I mean, we had a chance to use a leveraged ETF when the market followed through on January 6th, and we got that first buy signal from the indexes. But the reason we did not go with a leveraged ETF was we were just uncertain if stocks were really ready to start a new uptrend. So last year, we saw several follow-through days that really had a hard time getting going. They were almost always met by distribution. So this time around, we didn't even want to go near a leveraged ETF. We just went with a basic RSP, which is, like I said, was the equal-weighted version of the S&P 500. And I think leveraged ETFs for most people are not a great thing. They're very volatile. They're popular because it's almost like to me it's like a easy way to make quick money in the market, and that's always very, very risky, because if you're in a good uptrending market, it's great to make 3 times the S&P 500. But if we're in a volatile market right now where we can be strong one day and very weak the next. Those leveraged ETFs work against you, and those losses can pile up quickly. So they're not for everybody. I think they're marketed for sort of savvy, experienced investors, and I think for generally new people getting involved with ETFs, probably not the best way to go.
Yeah, you definitely need to know your risks. And like you said, I mean, they're great for trending markets. These are not just buy and hold and hope for the best, because you can really get burned, and proper portfolio management is paramount. You don't want to be holding and hoping while taking huge losses. That's not what you want to do. You can, however, ride a trend if we're seeing an uptrend and you have a solid profit cushion, but also follow those sell signals, as you mentioned, with those key moving averages to maintain those profits.
Yeah, just a comment on the RSP ETF here. Really like the look of this pullback. So you can see we've highlighted sort of the last breakout area for the ETF over that 150.20, and it has just kind of pulled back and is now really testing that last buy area, testing that 150 level. It's come off lows, so I like the pullback here too. So the RSP is really not giving us any making us worried that we may need to get rid of this and lock in profits. This looks like an orderly pullback right down to a former buy area, and it is just kind of holding that 150 level. So I think it still looks pretty good here.
Yeah, so we talked about the benefits of ETFs. We talked about how to track sector rotation and take advantage of themes that are working in the market by looking at ETFs. We've talked about leveraged and inverse and index tracking ETFs to get market exposure at key turning points. And we can also use ETFs to track market undercurrents like growth versus value. I know, we've been looking at ARKK as sort of a proxy for risk appetite and how speculative growth stocks are doing. You can also look at emerging markets, China, how other areas of the market are performing, commodity ETFs as well, like you mentioned oil. So USO, this is a proxy for the price of crude oil. GLD, we can also take a look at how gold is faring, copper, you name it, again, an ETF for everything. But we like looking at these market undercurrents, and like the dollar, this is something that we've been focused on a lot lately, seeing that inverse relationship between the 10-year yield and equities, as well as the dollar and your growth and your tech stocks especially.
Yeah, interest rates have been rising. The U.S. dollar has been rising, and this is a bit of a trouble spot for the stock market. But again, I think it's too early to get bearish here. Again, we kind of just observe the market on a day-to-day basis and make our decisions based on that. But yeah, you just went over a lot of different ETFs here, but this is the UUP, which is, if you want to go long the U.S. dollar, this is an ETF that you would want to look at. I want to go back to CPER that you pulled up recently because, you tend to see copper do well when, you have China opening up. You've got maybe increasing optimism that we may not be headed for a long, drawn-out recession in the U.S. And I'm certainly encouraged by the way CPER is trading here. Again, just looking how these ETFs react around key moving averages. Here was an ETF that ran up to 26, and it's been kind of pulling back in orderly fashion and finding support right where you would expect it to. So before we get too negative on maybe a reopening of China that doesn't go as planned, or get too negative about the health of the U.S. economy, looking at CPER here still has a pretty strong technical picture to it.
It does. And now, before we get to some more audience questions, let's briefly take a look at some current ETFs that we have found entries for recently. We looked at SMH already, so just a reminder for those. We saw a breakout above a prior high, and that happened on 123. So that was an entry there that traders could have taken advantage of in terms of taking profits into strength. Perhaps shortly after was an opportunity to do that. We'll see if SMH can find support at the 21-day line, or if losses worsen, potentially a sell signal there. Let's also take a look at retail. You mentioned XRT, a really strong move for the retail sector from around 120 and 121 to a peak at February 2nd here, Ken. So how might have traders played, or could they play the retail sector?
Yeah, so XRT is an interesting ETF because it really does not own a lot. It doesn't own the Walmarts and the Targets. It kind of focuses more on kind of smaller retail names. Not super speculative, but it does. It has like Sally Beauty, SBH in the top holdings, but it's not an ETF that focuses on the mega cap retailers. But that's good because sometimes you can get some pretty compelling growth stories in the small and mid-cap names. So the pullback in XRT, and this is another name that's in the leaderboard model portfolio. We put XRT on January 23rd, and it has really been an outstanding performer. You can see when it pulled back, it came right down to that green line, the 21-day moving average, and found support. Tough day for the market on Friday, but it is down about 0.3%, still acting pretty well here. So the XRT is and this may be counterintuitive to a lot of people. Hey, I thought the economy was in rough shape, and it's just only a matter of time before we're headed to a recession. Why would a retail ETF be doing well? So it's just why it's important to listen to the market. This is another ETF that's got a pretty strong technical picture still.
Yes, technical is so important to cut through the noise of what we're hearing headline-wise on the economic front, because the same could be said for ITB. This tracks the U.S. home construction area, which we've really seen come alive in recent months as well, like the broad market pulling back here today, testing support at its 21-day line after a strong move. This was an ETF that the team spotted early on in 2023, right, Ken?
Yeah, in January, it's a little later than that. Around January 20th, I think, is when it kind of pulled back to its 21-day moving average, and then it was up multiple days in a row, and now it's come back because of this kind of rising interest rate narrative. Kind of disappointing to see ITB lose support at the 21-day line today, but and our gain has shrunk. But this is the kind of the technical action we pay attention to with ETFs. If we want to lock in a small gain here, we probably have a reason to do it with the break of the 21-day line. We were kind of hoping it would hold here, but it could be a tough tide to swim against for these home builders if this 10-year yield keeps heading higher and the Fed keeps moving forward with this path of interest rate hikes. So rising interest rates typically not good for the home builders, and we're seeing that sort of play out in this ETF now.
That we are. All right, well, let's go over a couple of quick questions from our audience before we wrap up today, Ken. So I'm just going through here to see what we haven't covered yet. We kind of covered this maybe a little bit, but we could be a little more clear. There's a question about equal weighted ETFs. You believe those are better suited for moderately risk-averse investors than a standard ETF?
Yeah, the reason we went with RSP is on January 6th. Again, when we first got that buy signal, we went with the equal weighted ETF because we didn't really want exposure to the normal SPY, which is market cap weighted. We just rather have our risk spread out in the S&P 500. So there's not one company in the RSP that is having a big effect on it. So we just felt like this was a better way to get exposure to an index, going with an equal weighted index as opposed to a market cap weighted index. They had a lot of market cap weighted stocks, maybe a lot of large cap technology stocks in the S&P 500 weren't really clear that those were ready to outperform. So we just wanted an equal weighted ETF to just kind of spread our risk out and not be overly exposed to huge market cap companies.
Thanks, Ken. Okay, a couple more rapid fire questions. I'll take this one. And the question is from Jeff. Do we have a list of ETFs for review? An easy place that I can think of just off the top of my head is if you go to investors.com, and for the URL you type investors.com/live, LIVE, FAQ, investors.com/live FAQ. Scroll down to the bottom of that page. We have a pretty comprehensive list of ETFs that we like to take a look at and screen. That page that it's going to send you to is all about our show, IBD Live, but the main purpose I'm pointing you to that page is just to take a look at those ETFs if you are interested in a quick list of ones to add to your screening routine. Now, another question, Ken, that we have is what's the best way to add to ETFs that are in uptrends? Maybe there aren't a ton of pullbacks. I think that it would be great to have the patience to find a pullback, but what is a good looking pullback to buy or add to an ETF? What are some of the nuances there we should be aware of?
Well, let's go back to XRT, which has has been a pretty good performer for us, and this is the type of pullback that we like to see here. You can see it was a good buy and a nice strong heavy volume move, and then it pulled down to the 21-day moving average. So an opportunity to add could have been on that day. This is a half position. It's about a 5% weighting in the model portfolio. So whether an ETF pulls down to its 21-day moving average, some cases they may pull down to the 50-day moving average. And when an ETF finds support, you want to see a conviction bounce. So with XRT bounced initially, that is what I would call a conviction bounce. Didn't get huge volume behind the move, but you did get a nice percentage gain and a bullish close near highs. The following day, it didn't give up any ground, closed unchanged, showed support. So this is an ETF that is showing technical strength. We haven't increased the position yet, but the longer it holds above the 21-day line here, more likely we could probably increase it.
Okay, great. Another rapid fire question for you, Ken.
I forgot about the rapid fire part. Sorry.
No, that was great. Okay. That was great. Just a couple more here would be, what is the minimum liquidity or trading volume that you would like to see for an ETF? You mentioned some of them can be on the thin side.
Yeah. So with individual stocks, we typically like to see an average daily dollar volume of at least 20 to 25 million. With ETFs, we'll be a little more lenient with that. Maybe go down to the 15 million or so. But when you're looking at an average daily volume, I would say a general rule, you want to see probably an average daily volume of at least 300,000 shares, maybe 400, 500,000 shares, but definitely be wary because there's a large population of ETFs out there that trade less than 100,000 shares a day. So liquidity is important. So average daily dollar volume, which you get by multiplying the ETF price by the average daily volume. If you're in that 15 to 20 million range, I think you're fishing in the right pond.
Thanks, Ken. Scott is asking, what resources regarding ETFs are available via IBD and where can I find them?
Well, we do have ETF coverage, like I said, in IBD weekly, in our weekly print version. Just like Barrons, we come out once a week on the weekend. So good ETF coverage there. And then right on the homepage, I think there's a link at the research link at the top of the page can give you more ETF coverage.
Okay, and Sal's asking, should ETFs be compared with the S&P 500 to identify relative strength? And how do you determine whether you go with an ETF or an individual name in the group? So say this is a sector ETF, like your SMH tracking chips, or your TAN, maybe that's tracking solar, or even one of the biotech ETFs versus an individual name. I think it really does come down to that relative strength.
Yeah, so every ETF in our database, and you can see we're still looking at XRT here. We plot that relative strength line, the blue line, and we just compare it to the S&P 500. So, and that is typically what a relative strength line does. It's always either comparing a stock or an ETF and its performance against the S&P 500. In terms of individual stocks, buying individual stocks as opposed to a basket in an ETF, I mean, sometimes the market is acting so well, your growth screens are just yielding just buy opportunity after buy opportunity after buy opportunity. And there I tend to shy away from the ETFs and go with, individual stocks that, are likely going to have a little more power. But, if you're in a market where, breakouts are failing, or at least breakouts are a mixed bag, sometimes it just makes sense to go with a more conservative, like an SMH, rather than try to make money in a NVIDIA or an AMD. You just go with the SMH. That's just a nice big basket of chip stocks. So it really depends on how healthy the market is, how healthy the bull market is, and even though we're in a fairly healthy market right now. Again, the rising interest rate environment is still kind of keeping the market honest here, and it's it's a tough individual environment to pick individual stocks. So I think overall there's a reason why we have 6 ETFs in the leaderboard model portfolio right now, just as managing our risk basically.
Right. And you know what? I inadvertently provided a URL that is behind a paywall, and that was not my intention. I was not aware of that. So you know what I'm going to do? I'll put that list of ETFs on the YouTube version of this video. We'll put it on the Investors Business Daily YouTube channel by
Perfect.
end of day. So that is where people can check out that list of ETFs that I mentioned. So yeah, go on over and subscribe to our YouTube channel, and then you'll hopefully get a notification when this video posts there later in the day, and I'll include that link in the description. All right, well, Ken, I know we just scratched the surface here, but that was a very fun conversation. Any final words as we wrap up here?
I think sector ETFs are the most exciting ETFs in general for investors, whether it's semiconductors or consumer discretionary stocks. The S&P has 11 sector ETFs that we monitor on a daily basis. So still hoping the chip stocks, SMH, can continue their outperformance here. Market looking a little shaky here, but the uptrend is still very much intact. But I would say for new people starting off with ETFs, keep it simple. Go with index ETFs. You could go with a SPY, a QQQ, a DIA. We mentioned XLI, which is another good industrial ETF. But and then try to have when you're looking for sector exposure, go for the leading sectors, not the lagging ones. The leading sectors are going to have good RS lines, and they're going to be trending higher, not lower.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.